Hello, today we're going to have a quick discussion about this debate as to whether the Fed should run the economy nominally harder in anticipation of a big productivity boost from AI. Now, there's a lot of muddled thinking on this stuff. People that say AI is deflationary or disinflationary, the same way they might have said that, tightening immigration will be inflationary. It's just not a proper way to think about this. Things like productivity changes, immigration are real world phenomenon. They affect the supply side of the economy. The Fed controls nominal variables. The Fed operates on the demand side of the economy by controlling nominal aggregate demand or nominal GDP. Regardless of what is going on the supply side, immigration tighter, immigration looser, AI productivity boom, AI a flop, there will still be, for any set of those supply side conditions, some set of monetary policy settings that will produce 2% inflation. Okay, the Fed's job is to modulate nominal aggregate demand at a level of real potential growth plus 2. So currently, let's use round numbers, nominal running at about 5%. We've had inflation around 2.5, which implies real potentials around 2.5. So I would suggest we haven't really seen in the data an increase in the real potential growth rate. Furthermore, we did tighten immigration, which is offsetting whatever might or might not be happening on the productivity front because the labor force growth is stagnating. But again, the Fed can always hit 2% inflation by having an accurate forecast of what real potential is and running nominal at 2% higher. Now, it might be fair to say that something like an AI productivity boost is going to make it more likely that the Fed will make the error of running inflation below target. But it will still be an error if they do that. So if the central bank says it's targeting 2% inflation and we get anything other than 2%, ultimately that's on them. So how should the Fed be thinking about the current circumstances? I think it's a bad bet to be assuming a big productivity boost from AI. And again, big enough to overcome the contraction in labor force growth. Here's why it's a bad bet. If the Fed assumes that there's a big productivity boost and there isn't, what would that entail? Maybe they take the administration's advice, they run it hot, and they push nominal from 5% to 7%, assuming that real potential growth is going to go to 5%. It remains at 2%. What happens? We get 5% inflation. That's a disaster societally, and the Fed would have to crush the economy to fix that. So there's huge downside to assuming a productivity boost and not getting it. What's the flip side? Let's say they assume there isn't a productivity boost and we do get it. They leave nominal at 5 and real potential goes from 2.5 to 4. What happens then? We will get a 1% inflation rate. And under normal circumstances, that's a very difficult thing for the economy to withstand because corporations who borrowed based on 2% inflation on top of their real revenue growth rate will only get 1%. Some of them will struggle to service their debt. They'll go bankrupt, and that can spiral. So that's why inflation below what the central bank told people to expect is problematic. But if it occurs in an environment of stable nominal GDP growth, and it occurs primarily because real potential ended up being faster than the Fed thought, corporations who borrowed have an offsetting positive in that their labor force is getting more productive at 100 basis points per year more than they thought. So from a profit perspective, it should be a wash, which means those companies will not have the normal debt deflationary credit pressures they would if there was an inflation undershoot in the absence of a productivity boost. So without giving an opinion on whether we are or are not in the midst of a big productivity boom, I would say the risk reward does not favor assuming so if you're running monetary policy in the U.S. I think the Fed is correct to be circumspect on this point, and I personally would be very uncomfortable with running it anything hotter than what we have, which is about 5.3 nominal. I think if the Fed moves in that direction, you're going to see a lot of risk in the dollar, and I think the Fed's just going to avoid that dimension for now. They're not going to buy the Warsh-Hassett line that we should be running it hot on the assumption of productivity growth that may or may may not happen because the risk reward just not good.